Hi, this is Susan Dusek with Edina Realty and Team Dusek, and welcome to another edition of Everything Twin Ports. And it is that time of year where April 15th is right around the corner, and so we thought it would be a good time to bring in a good friend of mine and also a accountant extraordinaire, Mark Fredrickson, with the Hansen Group, to answer some questions for us that could come up as you're preparing your taxes and linked, of course, with real estate. So first of all, I want to say thank you so much, Mark, for being here.
Well, thank you for having me, Susan.
You're welcome. You're such a good friend. Thank you. Anyways, we'll just kind of jump into this and then we'll have follow-up questions and whatnot, but you're prepared, and so I really appreciate that. Let's start right away with how much our mortgage interest rate can be deducted. That's somebody always asks that.
Well, first, why don't I get a chance to give it a little background on myself?
Okay,
so I'm Mark Fredrickson. I'm with Hansen House Company. I'm a CPA. Been doing this a long time since 1987. So I've seen quite a few tax acts through the years. Taxes are always changing; it's a fluid thing. And my first bit of advice would be, unless you've got a fairly simple return, seek a professional.
Excellent. I would always do that. Absolutely. So thank you. You. I know you're cum laude of your class in UMD.
I was.
I read that about you. I always knew you were very smart. All right, well, let's go into this then. And my first question about mortgage and mortgage interest. Can it be deducted? How do we do it?
Yes, mortgage interest can be deducted. There are some things to be aware of. First of all, if you have mortgage debt over $750,000, not all of your mortgage debt is deductible. You're going to have some that is not. Usually not an issue in our area, but there are certain parts of the country that it can be. And so if you're fortunate enough to be able to afford something where you've got that kind of mortgage, be aware that not all of it's going to be deductible.
Okay.
The other thing to be aware of, we've got a lot of people refinancing right now. Since the 2017 Tax Act, your interest can only be deductible if the loan is used to either build, buy, or substantially improve your home.
Interesting.
So if you do a cash out refinance, you're going to have to do a little allocation, and that cash out portion of the loan, you apply that same percentage, and that's the portion of your interest that's not deductible. So you need to be aware of that.
Okay.
And then, your old home equity line of credit. So you actually have to look back and say, okay, what was that used for? And so home equity line of credits, it's the same rules. If that loan was not used to either buy, build, or substantially improve your home, that interest is not deductible. Now, there are a couple of things to also be aware of.
Okay.
The definition of a home is a little bit broad. So if you buy an RV and you take a loan out on it, that RV is actually a second home because it has kitchen facilities, it has a sleeping area, and it has a toilet. And so if you have something that has those three things, now it's a home. Same with a Lake Superior boat. So if you have a Lake Superior boat and it's got a galley and it's got a berth and it's got a head, perfect. That's a second home. Interest on that is deductible.
Tax deductible.
Mm-hmm.
Excellent. All right. Well, that was very helpful. All right. In 2017, we had some tax changes.
Yes.
Itemization tax changes. So what were those changes? What's the impact of them as a result of what happened in 2017?
So 2017 was a fairly significant tax act, and one of the big things that happened there is there was a big expansion in the standard deduction, and so as a result of that, roughly a third of taxpayers itemized pre-2017 Tax Act. Now that number's down to about 5%. And so two reasons. So the expansion of the standard deduction for married couples in 2020, that's $24,400. For a single person, it's $12,200.
Okay.
So big standard deduction, and then also the deduction for state and local taxes. So your state income tax, your real estate taxes, in Minnesota, your license tabs, that's capped at 10,000. So, if you take that 24,000, subtract off 10, now all your other itemized deductions need up to be 14,000, and most people don't quite get there.
Right.
So,
Right.
so big change there.
Right. Especially with property taxes, too. I know some homes in Duluth have such high property taxes. They weren't able to write those off anymore.
That's right. Well, they can still write them off. It's just that
Only
it's capped.
Yeah.
It's just that it's
Understand.
capped. So.
Okay. So let's get into some rental questions. What tax advantages do landlords receive?
So, real estate in general is a pretty favored area in the tax law, and so, you as a landlord, you get to deduct all the expenses associated with the property. So you think of some of the basics: your insurance, your utilities, your mortgage interest, your repairs on the property. You also get to depreciate the property, and so what depreciation is it's basically taking the cost that you bought that for, and you're allocating that as a deduction over time, and we depreciate residential real estate over 27 and a half years. So that's depreciation.
Okay.
And so it's really a pretty unique situation. So you can buy a property. You really only have to come up with, say, maybe cash that's about 20% of that.
Right.
You
Thanks
can
for
finance the rest. You get to write down that property as you own it, and yet hopefully it's appreciating in value.
Right.
You don't get to do that with stocks.
Excellent. Very good. Let's talk a little bit about capital gains. And I get that question asked all the time when people sell their home. And what do they have to, when do they have to pay capital gains? What is a gain? Like maybe a quick calculation, how you get to that.
Okay. So if we're talking about a home,
Right.
okay, first of all, you have to look at it and say, do I have a gain? Okay. So you take your original cost, add improvements that you made to it. And we're talking improvements. We're not talking about maintenance. So like if you painted your house, that's not an improvement. But, if you finished the basement, if you, redid a room, if you did some major landscaping, those kinds of things, those are improvements. So you add that to your cost.
Okay.
And then you compare that to what you're selling it for. And so you take your selling price and you're able to deduct from that your selling expenses, so your real estate commission, most important,
Yes.
right?
Yes.
Your real estate commission, and then some of the other fees that you can run into as part of selling your home, you compare those two and you look at that. The difference is your gain.
Okay.
And so if you're married, as long as that gain is less than $500,000 and it was your primary resident, you don't have any tax to worry about.
Right.
If you're single, it's $250,000. That's the amount of gain that you can
Right.
exclude.
Right.
If you have more than that, then you've got to pay tax on that.
Okay.
Now, if we're talking about rental property,
Yeah.
that's a whole different story. So rental property, there is no gain exclusion.
Primary residence mostly, isn't it?
Only your primary residence. So if you're selling a second home, you're selling your condo in Florida, you're selling your cabin, that's taxable also. Yeah. But if we're talking about rental property, you take your original cost, you also have to subtract off the depreciation you've taken. And that's your basis to determine whether you've got a gain or loss.
Okay.
Now, another unique thing about rental property is you can do what's called a like-kind exchange. So let's say you've got somebody that's really interested in your rental property, but you maybe want to upgrade, and so let's say you've got a single-family residence that somebody wants to buy, and you're thinking, you know what, it's time to have a duplex or a triplex. You can, and you have to, there's certain rules of how this has to work that we're not going to get into in this situation, but you can take, and as long as you don't get your hands on that cash, have a third party that does this, you can trade. You can essentially trade that single family residence for that duplex or triplex and you defer the gain. You don't have to pay it until you sell that duplex.
Right.
So, again, another area where real estate is a tax-favored investment.
Yeah. Is that the 1031 exchange?
That's the code section 1031
Okay.
tax-free exchange.
People talk about that and they throw that around, so
Yep.
very interesting. All right, let's stay on rental property. What are some other tax advantages, maybe to purchase a rental property or VRBO? Those are really popular right now. And then what do you want to look at if you're doing this? If you're a newbie maybe coming into this, what do you look at?
So this is an area that we call vacation rentals.
Yep.
And we're seeing more and more of that, with VRBO and Airbnb. It's made it a lot easier to be able to rent your property, and so I've probably a tenfold increase at least in the amount of clients that I have that are doing this. So, a couple things to be aware of. You have to look at your personal use of the property, okay? And so 14 days is a key number. And so the first thing to talk about is if you rent your property for 14 days or less.
A year?
Yep.
Okay.
That cash is tax-free to you.
Really?
It's called the Augusta rule,
To rent during the Masters or something?
Exactly.
Okay.
So, all golfers, of course, know the
Yeah.
Masters,
Yeah.
and most non-golfers know the Masters
Yeah.
tournament. And so what happens in Augusta is, all these corporate hot shots and all the golfers, they come down there and they rent these old antebellum mansions.
Yeah.
And so, most of the residents of Augusta get the heck out of town and they rent their places. And so, tax lobbies are tax lobbies, and I don't know how they got it in there,
Free
but
money
you
for
can
14 days.
And so if you think about it, here in Duluth, you could rent your house for Grandma's weekend and do that tax free. Or let's say you have a cabin and there's certain weekends that you're not going to be there.
Right.
Just keep it under 15 days, and that's tax free money to you.
And no cap on that.
No cap. So. Yeah, so
I just
very
learned something new today.
very interesting little quirk in the tax law.
Okay.
Now, getting back to this 14-day thing.
Right.
So, if you have this vacation rental and you're there using it personally for 14 days or less, and you actually have a loss from that activity, there are other restrictions, of course. There's passive loss rules and some of these other things, but you are able to deduct that loss. If you're there more than 14 days,
Okay.
Now that loss gets carried forward. You don't get to deduct that against that current year's income.
Okay.
It gets carried forward to future years. Okay.
Okay.
If you're using it personally, you have to look at your personal use versus the rental use, and that allocation percentage, that's what you apply to all your expenses. So, when you've got mixed use, you don't get to deduct 100% of your interest or your real estate taxes or your utilities. It's the percentage that is actually rental use that you get to deduct.
You calculate that per year, the percentage of what it's been rented.
That's correct.
Hey, I'm feeling smarter.
Now, when you're looking at that 14 days,
Yeah.
Work days don't count. So let's, and again, this happens quite a bit, you've got the Florida condo and you fly down there in November to get it ready for the season, and so you're there a week. Well, okay, what days are personal days and what days aren't? Well, you have to work a significant part of the day. So if you're down there and you just you vacuum and wash shampoo the
windows,
floors and wash the windows, and you're done by noon and you're on the golf course, that's not a work day. It has to be pretty much a full day's work.
9 to 5. Okay.
Yeah. But those don't count as a personal day.
Okay.
Okay.
Interesting. Wow. All right. Well, we have a new president. And this is one of those crystal ball questions, and I'm sorry to throw this on you, but what do you anticipate with the Biden administration?
So there's a lot of information out there. It's not very hard to Google to find out what his tax proposals are.
Right.
if you make more than $400,000 a year and his proposals get through, you're probably looking at some sort of tax increase.
Okay.
If you make more than $1 million a year, you're probably not going to have any preferential rate on your capital gains.
No, true.
So now those are all these things have to get through the Senate, and so who knows what happens there. Other things that are out there, it's pretty clear that he wants to raise the corporate tax rate from 21% to 28%. My guess is that that's probably the most realistic thing that could happen in terms of what's happened during the pandemic. A lot of big corporations have actually done quite well, and so I think there's probably a good chance that would pass. I think a lot of his individual provisions, less so. One of the things he wants to do is remove that $10,000 cap on the deductibility of state and local taxes. So we'll see what happens. But it's things are a little messy in Washington right now.
Yeah.
So it's hard to predict what may or may not be passed.
I just didn't. You're more red than most people, so you would know maybe if something came up.
And that's READ.
Yeah, right. Not RED. Yeah. All right. Anything new this year? Something that came from maybe last year, or,
there's a lot of stuff out there, but things that could affect most people. If you're a non-itemizer, you do have up to $300 that you can claim in charitable contributions off of your income. So even if you take the standard deduction, this was in the CARES Act, you can deduct $300 of contributions. So it's interesting when that increased standard deduction happened. I looked at that and I said, "Wow, this is going to be tough on charities because a lot of times charitable giving is tax motivated."
Right.
And it's kind of been a mixed bag from folks in the nonprofit area that I talked to. But obviously, Congress recognizes that some giving is tax motivated, so they did put in this provision. So there's that. These stimulus checks that are getting mailed out.
Right.
A lot of people look at it and they say, "Hey, I didn't get the full amount this last go around." Or maybe you were a college student that was a dependent last year, but you're filing on your own this year.
Right.
You can still get that. It just comes as a credit against your taxes in 2020. And so ultimately what happened was those checks that got mailed out were an advance payment.
Right.
And what happens now is it's really based on what your 2020 income is and your 2020 filing status.
Okay.
So.
Okay. Wonderful. Well, those are my questions. Have I forgotten something? Is there another little tidbit or?
We could spend hours. We'll do that on the pontoon this summer.
Yeah, that's true. That's true. I think you'll lose me. It gets too complicated. But I just wanted to thank you so much. This has been really helpful and really informational. And I want you guys all to tune in. And just remember, Mark Fredrickson at Hansen House, and they do personal taxes. He works a lot with companies, but give him a call. And we appreciate you tuning in to Everything Twin Ports. Thanks a lot.